So in my view, the objectives of the Capital Markets Union should be threefold. First, to put European savings to better use by deepening and by diversifying the sources of finance available to business, and by offering more investment choices and portfolio diversification to savers. As was recognised in the Giovannini report 20 years ago, there is very good economic reason to believe that improving the efficiency with which savers are matched to borrowers will improve economic performance. The second objective should be to enable greater risk sharing across the EU by creating deeper cross-border markets. Cross-border investment allows economic risks, upside risks and downside risks, to be shared across individual countries. Done in the right way, this can help smooth out the impact of economic shocks that hit individual countries, reducing the danger of economies sliding into very deep recessions that can permanently damage their ability to grow. While this smoothing through risk sharing is a benefit to all EU members, as the recent crisis has shown, and I think the ECB has pointed out, it's particularly important for the euro area given the relative lack of adjustment mechanisms and risk sharing available to individual euro members when they are hit by economic shocks. And the third objective should simply be to create resilience by ensuring that if the banking system is damaged, there is an alternative, effective channel of finance to the real economy. It's very probable that one of the reasons the US recovered more quickly from its financial crisis was that in the US, banks do not dominate the provision of finance to anything like the same extent as they do in Europe. And so when the banking system was badly damaged in the US, a well-developed alternative existed to help meet the financing needs of the real economy. To achieve these three objectives, reforms will be needed on both the supply side of the equation and on the demand side of the equation. I'm afraid with economists you never get away from supply and demand. The supply side of the equation has got two dimensions. First, we have to enable more household and corporate savings to flow to vehicles that will invest in capital markets. And second, we have to encourage more investors to allocate their savings across the borders of EU countries. As I've noted, assets under management in Europe outside the banking system are typically about half of the size of the US. So creating large pools of market-based capital is in part about creating the right investment vehicles to capture those pools. It will, I think, require maybe a more fundamental look at the way in which Europeans save and the way those savings are invested, including for their pensions, which in many member states are concentrated in public sector schemes. In practice, I think this will mean examining whether there are obstacles and competitive distortions that restrict savings being invested in financial markets. And the result of those examinations could well involve a greater standardization of investment products, and UCITS might be a good model here. On the demand side of the equation, the borrower's side, it involves enabling borrowers to access funds from market-based sources. Creating more diverse forms of borrowing will be part of the story. This could include forms of financing in which investors directly acquire assets, such as equity and corporate bonds, and indirect forms of finance in which banks and markets combine together to lend to the real economy, such as through securitization. The US example is also useful here. Despite the US having an equity market that's nearly twice as large as the EU as a proportion of GDP, the actual leverage of non-financial companies in the US is only marginally higher than in the EU. The reason is that companies in the euro area and the EU, particularly smaller ones, have equity but issue a much smaller proportion of marketable quoted equities, instead relying much more heavily on non-marketable unquoted shares. A more integrated capital market would provide deeper, more liquid equity markets in which a wider range of corporates could issue equity and risk could be shared more widely. There is, I'm afraid, though, no free lunch. Increasing the scale of cross-border capital flows across Europe brings benefits, but it's not without risks. One doesn't have to go back to the period in which I started, the late 1950s, to find examples of the power of cross-border capital flows to amplify crises when it all goes wrong. That's why they have to be built on the foundations of sustainable economic policies, good regulation, and robust institutional structures. The nature of capital flows matters as well. Europe was not short of cross-border capital flows before the crisis, but they were concentrated in interbank lending and in debt, which was often held by highly leveraged investors. And interbank lending can be a very dangerous way to share risks between economies, particularly if the banking system is highly leveraged. If losses have to be shared on a large scale, this puts the very core of the financial system in peril. Corporate bonds and securitized assets can have similar risks, especially if they are held in the majority in the banking system. And debt instruments generally can be destabilizing if they cannot be easily restructured when losses occur. Equity provides the most efficient and the smoothest form of risk sharing, suggesting perhaps that this should be a priority for the Capital Markets Union. And the nature of investors matters as well in ensuring that cross-border market-based financing in the EU will not increase financial stability risks. In general, sources of market-based financing are likely to be more resilient if the investor base is diverse, if it's sticky, and if it's not reliant on leverage. To conclude, it's abundantly clear from all of the above that achieving the necessary step change in market-based financing in the EU means a marathon and not a sprint. And although it shares some of its nomenclature with the Banking Union, Capital Markets Union is, I think, a very different animal. The former, the Banking Union, is essentially designed to improve the stability of and the stability between Euro members through institutional change and through moving major financial stability responsibilities to sit up at the Euro level alongside responsibilities for monetary stability. And it was possible in the EU to make those institutional changes relatively quickly, even though their implementation will take much longer. In contrast, Capital Markets Union aims to deepen and to widen the single market, though of course it needs, as I've said, to have regard to financial stability. It does not require institutional change. Though there may be early wins, it will involve a carefully planned, detailed and sustained effort over a number of years and over a very wide range of areas. But the benefits, I think, could be very large indeed. Thank you.